Okay, so now what I'll do is that I'll share the screen and then the PowerPoint, and then we can get started from there. Host this table participants sharing. So I think at your end too, you have to enable. I think now you are the host, so you have to enable me to share my screen. So if you can do that over there for me, so that I can share the screen. Please, have you done that for me?
Yes.
Let me try sharing. Okay. So share my screen.
Is it done?
Yes, it's done. So I'm trying to share my screen now. Share sound. All right. I believe you can see my screen now.
Yes, I can. I can see your screen now.
That's good. Okay, so welcome to another session. And today we'll just be talking about the basics, the little stuff that we'll have to get to know before we start proper trading itself. And with this lecture, we'll just be going through the basics. Since I gathered a few information from you the other time we met, I also compiled a bit of beginner lessons for us to go through again so that we'll get to understand the Forex market itself before we get to the technical analysis of things. Because if you don't really know what you are analyzing, I mean, what's the essence of you analyzing it in the first place, right? You have to know what you are analyzing, and you have to know, I mean, the basis of it is going to guide you and build you up and give you the skill that you need to progress with the Forex trading. So we'll first look at, this should have been the first question. I mean, any beginner would ask somebody who trades. Okay, so probably be like, I've heard about Forex. What is it about? Okay, so the Forex is a combination of two words. Okay, foreign and exchange. And then the foreign exchange market is a place where we buy and sell currencies. Okay. And then all we have to know here is the buying and selling of currencies, the exchange between one currency and another. Okay. And before you be able to exchange one currency and the other, you either have to buy or sell. Okay. So some bits of transaction has to go on there for a Forex market to be called a trading platform. Okay. And traders normally include banks. So banks are also a group of traders. They buy and sell currencies, like we all know. Sometimes we go in there to exchange, let's say, a dollar for CDs. And we also go there to exchange a dollar for any other currency that we want to buy. So banks are currencies. Corporate institutions are also corporate institutions are also traders. The government is a trader. Investors and retail traders are the group of people like myself who speculates on currencies and then buy or sell with the hope of making profits out of that transaction that we make. Okay. So that is all about Forex. That is the meaning of it. Buying and selling of currencies is the basis for Forex. Okay. Now I will have to introduce myself a little bit here. My name is Raymond. My full name is Raymond Ikwe. Okay, but currently I'm a medical laboratory scientist in one of the government hospitals here in Ghana, but I also do Forex trading by night. So scientist by day, Forex trader by And my goal is to make money out of money. It's more like making your money work for you. That's how I term. That's the goal that I have in mind. Okay, so it's like whatever
Okay.
elsewhere, I invest it into my forex trading account. Try to make more money out of my salary. Basically, that's what I have been doing, and I've been doing this for the past. I've been trading forex for the past 4 to 5 years now. I mean, my
Wow.
first 2 to 3 years was not so good. I didn't really make any profit. It was more like me trying it out. It got to a point I nearly gave up because it became so difficult to earn, to make profits, honestly. And it's all because I didn't have a strategy. I didn't really understand what I was doing at the point. But I think for the past 2 years, things have been stable. The forex trading, I'm beginning to understand the forex markets very well. And one thing that you should also know is that once you begin to call yourself a forex trader, your learning process never ceases. You continue to learn learn new stuff, employ them into your trading, and then at the end of the day, you are trying to build yourself up, or you are trying to build a strategy for yourself that is going to make you more profits, and make sure that the strategy that you build, you will stick to it, and you apply the principles that guide that strategy, so that you'll be consistent in making profits. But once you don't have a strategy, you also don't have a winning plan, you are bound to be losing all the time, right? So as a forex trader, you should keep on learning, and you should keep on building your strategy up. Okay. Now, when we move to forex, there are specific trading hours that we normally focus on. Okay, though the forex market is open 24 hours in a day. Okay, but then normally the market opens from Sunday to Friday. Okay, now Sunday evening in Ghanaian time, the market will open around 10 p.m. in Ghanaian time, and then on Friday
Okay.
it closes at 10 p.m. on Friday as well. Okay. On Sunday, trading on Sunday is not the best idea, because when the market opens on Sunday, what it does is that it does something we called, how do we call it? They have a term for it. I'm trying to remember. It consolidates. Okay, so the market doesn't really move in any particular direction. So when I say consolidation, it's more like the market it's not trending. The market is ranging. The market is in a flat move. The market is not moving in any specific direction. Okay, so on Sunday evening when the market opens up, we don't trade on Sunday. So normally you look for your setups on Monday, Tuesday to Friday. So like you can see from the presentations, they said the FS market is open 24 hours a day. Please give me a moment. I'm coming. Sorry, I'm coming inside. I'm having a session here. Yes, Vince.
Yes, bro.
Sorry, I hope you can hear me now.
Yes, I can hear you.
Sorry, I had a call. I'm using my phone as the hotspot to my PC, so I had
Okay.
All right, so let's continue. Now, the trading hours, like you can see from the presentation, the FS market is normally open 24 hours a day. Like I said, Sunday, 10 p.m., and closes on Friday, 10 p.m. Okay, but then Sunday, the market will go into consolidation, so you don't trade at all. But then you'll be looking for your setups from Monday to Friday. Okay, but then at the same time, when the market opens up, okay, when the market is opened, the market normally trade within specific trading hours. Okay, the market normally trade the World Trading Centers being located in London, New York, Tokyo, Zurich, Frankfurt, Hong Kong, Singapore, Paris, and Sydney. But then they have four major countries or four major cities where they trade a lot of how do I say it? Let's say their trading volume is very large or huge that during those trading hours, you see a lot of movement in the market. So during those trading sessions, especially the London session, the New York session, Tokyo and Sydney session, you see a lot of market moves, and those are the areas where traders target to make a lot of profits. Okay, normally during the Zurich or the Zurich or the Asian sessions, the market normally goes into it goes into consolidation and doesn't really trend like it does in the London and New York, Tokyo and Sydney sessions. So normally when you trade during the Asian session or let's say during any other session outside the New York and the others, you will end up not having any profits or losing your trade because normally when the market is going into consolidations, it doesn't really have a clear trend, okay? And it doesn't also move up in amount of profit that you need. So normally as a trader, you should be focusing on the London, New York, Tokyo, and then the Sydney session. Personally, I focus on the London and the New York session. Tokyo and Sydney, I don't really go there because I still see it as it doesn't really move like the way I really want the market to move. So normally I call those parts the Tokyo and then the Sydney sessions. I call them the lending closing sessions because that is when the market is trying to close for the day, and then normally the Asian session begins the day, and then the New York comes in, and then sorry the lending comes in, the New York comes in before it closes for the day. So normally I want to be active when the market has the highest, when the market is trading with the highest volume of money, okay? Because during those times is when you can really make a lot of profit. I don't know if you understand me up to this point.
I do. I do.
So as a trader, we'll be focusing on London and New York. When we get to the technical analysis of stuff, you truly understand what I'm trying to say. So for now, you keep it in mind that these major
All right.
London, New York, Tokyo, and Sydney, they are major cities where you can be looking for trades within those sessions. I'll give you the time frame for all of that. Okay, so let's move forward. Okay, so Forex. Now, per statistics, we know that statistics gives us this information that the Forex is the most traded asset when it comes to the marketplace. So we are saying that in a day, the Forex can record an amount of $5 trillion transactions going on day in, day out every day. It means that there's a lot of money going into the Forex. People are really buying and selling currencies in a day. Okay, that's what this information is talking about. It means that it's a place where we can also involve ourselves in, engage in that transaction, and then make some profits out of there as well. Okay, people do trade stocks, commodities, and other stuff, but Forex is the place where people really send in a lot of money and also sometimes gain a lot of money from. A lot of people do lose money trading Forex though. So it's something that we have to take note of as well. And now we've explained Forex, we talked about the statistics, we've done a lot of petty basics there, but what is Forex trading itself? Okay. So like the other time I mentioned, it's more like you placing a bet on something with the hope of you earning profits when the bet goes in your favor. Okay. So the first point states that Forex trading is the speculation. Okay, so I want you to underline that word. It's a speculation on the price of one currency against another. Okay. So for example, if you think the euro is going to rise USD dollar, you can buy the euro USD currency per low and then sell. Okay, hopefully sell it at a higher price to make a profit. Of course, if you buy the euro against the dollar and the US dollar strengthens, you will then be in a losing position. So what this means is that, let's say you go to the bank, okay, after your analysis and everything, you realize that within a particular given time frame, the euro is going to gain strength in terms of how do I call it, value over the US dollar within the shortest possible time. You want to buy some of the euro before that change happens. You want to buy the euro when it is at its lowest price. And then if indeed your speculation is right, and then the euro gains value, okay, you then sell that euro to earn profits. I don't know if you do you understand me now? Okay, so let me.
I got you.
You are
Yes.
okay, okay. But then in the same vein, let's say your speculation goes in the opposite direction. Okay, you have the mindset that euro is going to gain some profit. Let's say by 12 p.m., euro is going to gain strength in value. But then by 12 p.m., let's say at 8 or at 7, you've already bought the euro, okay, and sold your USD. And then when it's at 12, euro doesn't gain value, but rather depreciates in value, there will be a loss for you, okay? So that is what happens to us traders. Normally, we buy or we sell currencies. That is what we do. When we buy, we are hopeful that we will gain profits when the currency pair that we've bought has gained value. But then when it loses value, it goes against us. That is what we do, okay, as forex traders. So we do speculations and then we'll place our monies on the speculation. So if I'm speculating that the euro is going to gain value against the US dollar in the next 30 minutes, I want to be a buyer now, so I'll buy. And then in the next 30 minutes, if indeed it goes in my direction, I'm going to sell, okay? And then just withdraw my profits out of there. Okay, so that's all about forex trading. It's about speculations. And the speculations are based on you doing your proper technical analysis. Sometimes we do a bit of fundamental analysis, and fundamental analysis talks about you using news or a bit of data from governments or from other institutions to guide you in trading. Okay, so let's say you using data from inflation rates, you using data from unemployment rate, the price of oil and other commodities. These things can guide you and give you a proper understanding of how the market is going to move in the next given moments or hours. And with that, you can combine the fundamental analysis with your technical analysis, which is you analyzing the charts to determine the direction of the market. And then with that, you can base your speculations on these two. That's the fundamental and the technical analysis to guide you in placing a trade. I hope you understand. Hello, Vince.
Yeah.
All right. So let's move on to the next thing.
Yes.
All right. All right. So now exchange rate. I felt like we should talk about this. You know, normally with the currency pairs that we trade, I mean the Forex market, we express the forex currency in terms of we combine two currencies, and let's say we'll term it as Euro USD. Okay, so we normally do them. Okay, so for the forex pairs or for the forex market, we trade currency pairs. Okay, so for Euro USD, when you see it like this, normally and you see a value, let's say Euro USD is 1.32. What it means is 1.3200. What it means is that 1 euro is worth 1.32 US dollars. Okay, that is what the exchange rate means. And then normally the first out of the two pairs, the first pair, which is the euro, will be termed the base pair. Okay, then the quoted will be the second pair. Okay, what the base pair and the quoted means is that the base pair is normally what you are either buying or selling. Okay, and the quoted pair is normally what you have that you are using to buy or sell something. I don't know if you understand. So let's say I go to the bank, I want to buy euros.
I got you.
Okay, you want to buy euro. It means you have a quoted currency of USD. Okay, so now 1 euro is worth 1.32 USD. So for you to get 1 euro, you have to have 1.32 USD to get 1 euro. I hope you understand. And also, for you to sell,
Yes, please.
it comes to the selling aspect too. Let's say you are selling. When you are selling to still your euro is your base, your quoted currency is what you are going to deal with. Okay. So normally the value we see there is the value for the quoted currency. So let's say I want to sell euro. 1 euro is worth 1.32 US dollars. Okay. And so it means that for me it means that if I have 1 euro, I'm going to 1.32 US dollars. That's basically what it means. So let's move on to the next thing. I also feel like we should talk about something called pips. Okay, so for pips, normally for the Forex market, okay, we determine our profits by measuring the change in price value, okay, and then we'll multiply the change in price value by the amount we used in either buying or selling the currency that we were interested in, okay. So we say pip.
Mm.
Full name for pip is percentage in points. Now, the pip is the smallest increment of price movement a currency can make, also called points or points. Okay, it's a percent. Honestly, the name is percentage in points. Okay, for example, one pip for Euro USD is equal to 0.001, and one pip for USD JPY is 0.01. Now, what this statement means is that now look at the Euro USD picture. Now we can see that we have 1.14988. Okay. Normally, some currencies are being quoted in 4 decimal places, and some currencies are also quoted in just 2 decimal places. Okay. Now, there are times you won't see the 4 decimal place, but you rather see a 5th decimal number. Okay. Normally, the 5th decimal number is called a pipette. Then the next one, or the 4th number, is called a pip. Okay. Now, between when you let's say you bought Euro USD for 1.14988, and then later you sold it at 1.4998. What it means is that the only difference that you've made is the only difference that has been made is that in between those two price points, there's a difference of just 1 pip. And this is how you calculate your pip. You subtract the current price from the previous price that the market was trading at. Now, when you subtract these two, you realize that you have a value of 1. For this one, if it's 5 decimal places, you realize that you have 10. But like I said, the last or the 5th digit, you run it up to a decimal number. So if, let's say, we subtracted these two and we had 10, we have to run it back with, or we have to divide by 10, then we'll get 1.0 pip. Because normally the Euro USD or most currencies are expressed in just 4 decimal places. The last decimal place, or when a 5th decimal is present, is a pipette, and such a pipette, we treat it as a decimal. Okay, so we call it, how do we say it? So normally, if this one was like, let's say I had 1.49888, and then for the one in red, I have 1.4997. What I'm going to have, 1.4999. Okay. What I'm going to have now, I think I have 10 minutes left to finish up. Let me finish the presentation. 4999. What it means is that after you subtract, you are going to have 11. But because of the 5th number, you have to run it up by 1 decimal place. You have to divide it by 10 to get 1.1. So now you have a change in price of 1.1 pip. I hope you understand.
Yeah.
Now for the USD JPY, normally they are expressed in 2 decimal places. But if you see a last decimal, or if you see a 3rd digit after the 2nd decimal place, that one too is a pipette. And normally we express it in terms of decimal. So let's say for this one, if let's say we were previously trading at a value of 123.406. Okay. When we subtract that previous value from this one, we are going to end up with a value of 56. But because this one is in 3 decimal places, we'll divide by 10, and then we are going to have 5.6. So now the change in value from where we were previously trading at to where we currently are will be 5.6 pips. I hope you understand.
Yeah.
Now let's move on to the next thing. How to finish up. Now leverage. Okay. Now previously it was assumed that there was nothing like retail traders. Traders were more like the banks, corporate institutions, those who have larger funds to trade. Okay. Because before you'll be able to open up any position in the forex market. Previously, you needed to have a huge sum of money before you can even open just one position. Okay. But with the help of brokers, okay, brokers are more like intermediaries between a forex trader and then the forex market. Okay. Now brokers came in and gave us something we call leverage. Okay. Now leverage is more like borrowed money. So they gave us money, or they borrowed. Brokers, what they do is that they will borrow you money, okay, in addition to what you already have with them. Okay, your margin is money that you've deposited with the broker. Okay, once you've deposited money with the broker,
Okay.
then again go ahead to borrow you some amount of money. Okay, and then with that amount of money, it enables you to open larger positions, which is a requirement for you to be able to trade the forex markets. Okay, now you being given this leverage, normally leverages are expressed in terms of ratios. So you see something like 100 by 100 is to 1. What it means is that you have one part, you've just contributed one part. Okay. Okay, so let me read this one. I think this one will make sense. So for instance, if a trader has $1,000 of margin in his account, that is money that you've deposited, and he opens 100,000 position, he leverages his accounts by 100 times, or 100 is to 1. So what it means is that if you have $1,000 and you have a leverage of 100, it means that you've been given 100 times more the money that you have already deposited with them, so that you'll be able to open trades that are, normally any trade you open is being expressed in terms of thousands of dollars, and you don't have that amount of money. Probably you just have $100 to trade with. So you being given a leverage of 100 means you've been given 100 times the amount that you have in your account for you to be able to trade in the market and even earn more profits or bigger profits than what you've already deposited in there. I hope you understand.
Yes.
Okay. In case you don't understand, you try to let me know. Maybe I'll find a simpler thing to make you understand things better.
All right, sure.
Okay. So let's.
At first, I was a bit confused regarding the leverage, but now I think it's clear.
Okay. That's good. Now let's move on to the next thing, currency pairs. So you say the exchange rate of two currencies is quoted in a pair, such as Euro USD or USD JPY. I think I've talked about this. Now the reason for this is because in any foreign exchange transaction, you are simultaneously buying one currency and selling another. If you were to buy the Euro USD and the euro strengthen against the dollar, you'll be in a profitable trade. So I think I've talked about this already. So I'll move on to the next slide. I will talk about bid and ask price. Okay, so bid price, from the presentation, it says the bid is the price at which the market or your broker will buy a specific currency from you. So it's more like the bid price is you're selling the price that has been set for you to sell a particular currency to a broker. Okay. And then the ask price is the price that normally you go to the broker to buy a currency pair from them. Okay, I hope you understand. So let me explain that.
Yeah.
So, yeah. Oh, if you understand, then we can carry on.
Yes. What I do understand is say for instance, the bid price is what they are selling.
Yes.
Sorry. Yes, what they are selling in the market, and then the ask price is what you have.
Okay.
Can you hear me, please?
Yes, I can hear you. You can continue, please.
Yeah. So as I said Yeah, the bid price is what is selling on the market. That I mean, what you are selling on the market, and then the ask price is what they are selling. I don't know if that is how it is.
So let me explain it better. So let's say you move to the bank and you want to buy, okay. You want to buy, let's say, US dollars, okay. Now the US dollars, how do I call it? Okay, let's say you have US dollars and you want to exchange for cedis, okay. When you move to the bank, they have a rate for you to sell that USD to them to get your cedis. Now that amount that has been set to sell your cedis to sell your dollars to get cedis is the bid price they've set for you. But let's say now you move in there, you want to buy US dollars. They also have a rate they've set for the USD to buy and then get to give your cedis to and get your USD. I don't know if you understand. So let's
is clear.
use US dollars for as the basis, okay? So if you want to buy US dollars, they've set the ask price for it. So they will sell the US dollar at a particular rate to you. So now you bought US dollars. Now later on, you want to go and sell that US dollar for cedis. Now, if you are going to sell, they will tell you that they will give you another rate for the cedi. And then now you are going to, so it's more like they'll give you a price to sell what you already have to get what you want. And that one will be the bid price. But if you are going in there to buy the US dollar, they will give you an ask price. I don't know if you understand me.
Yes, I do understand you.
All right. So now the
This
difference,
is clear.
okay. The difference between the bid price and the ask price brings something we call spread. Normally, when we are trading, you see something called spread on the charts. Now, the spreads are the difference between the bid price and the ask price. Now, the spread is very necessary because it guides you on what currency pair to trade. There are some currency pairs, they have a very wide spread, or there are sometimes certain brokers that offer very wide spreads. When the spread is so wide, you do not want to deal with that broker because you will either always be at a loss, or it's either your trade will never get triggered, or it's either the point at which you expect to get some profits, you will never get it. So sometimes it's best to trade with brokers that do have less spreads, okay? Now, there are two types of trade. You either go long or you go short, okay? When you go long, it means you are buying a currency pair and later selling it for profits, okay? That's what it means. When you go short, it means you are selling a currency pair, okay? You are selling a currency pair. So when you go short, it means you are selling the market, and so we want the market to fall so that we can then buy back our position at a lower price than we sold it for. This means we are selling the first currency in the pair and buying the second. So if we sell the GBP USD and the British pound weakens relative to US dollar, we will be in a profitable trade. I hope this is understandable.
Yes. If I may ask a question, the spread.
Okay.
Whenever you want to, let's say, buy